Welcome everyone to this explainer. Today, we're absolutely cutting through the market hype to look at the hard, cold data behind one of the most talked about upcoming market debuts, the Manipal Hospitals IPO. If you've been following the financial news, you know there's a massive amount of chatter surrounding this offering. But as smart learners and investors, we know that chatter just isn't enough. We need to understand the mechanics, the scale, and the true financial health of the underlying business. So we're going to unpack the draft red herring prospectus to see exactly what's driving all this excitement. Here's our roadmap for today. 1. The IPO market hype. 2. Manipal's business footprint. 3. A deep dive into the financials. 4. Stacking them up against peers. And 5. A focus on the fundamentals. Let's jump in.
Section 1. The IPO market hype.
So what is exactly behind all this buzz? Well, if you're tuned into the markets, you know a huge chunk of it comes down to the headline-grabbing gray market premium, or GMP. People are constantly tracking the GMP today, along with cost-ac rates and subject-to-solder rates, just to get a feel for things. Before the official IPO announcement is even fully processed by the broader public, the gray market has already started placing its unofficial bets. It's kind of wild, but retail investors are glued to these daily fluctuations as an early indicator of listing day performance. We're all just waiting for the final IPO announcement.
For example, the Manipal Health IPO GMP hit a noticeable high of 50 rupees on July 20th. That's a massive jump considering it was sitting at a low of 0 just a few days prior on July 17th. Now, we absolutely need a vital disclaimer here. We are not buying or selling IPO forms on the gray market. That GMP number is strictly an unofficial, unregulated sentiment indicator that is valid only for that specific date. But it undeniably shows that retail excitement is building incredibly fast.
You might also be hearing terms like the cost-ac rate flying around. Basically, this is the premium someone gets by selling their IPO application in an off-market transaction to someone else, even before the allotment or listing of the issue is actually finalized. It's fascinating terminology that definitely drives the current buzz. But let's pivot for a second. Smart investing means looking way past these off-market premiums and diving straight into the actual fundamentals of the company.
All right, let's dig into the core details. This main board book-built issue is tentatively scheduled to open on July 27, 2026 and close on July 29th. The sheer scale here is just massive. We're looking at a fresh issue aggregating up to approximately 8,000 crores, right alongside an offer for sale of over 43 million equity shares. The face value is set at 2 rupees per share. This is a monumental capital raise designed to fuel some serious corporate objectives. And look, an issue of this magnitude naturally brings in the heavy hitters. The merchant bankers managing this, the book-running lead managers include Kotak Mahindra Capital, Axis Capital, Goldman Sachs, Jefferies, JP Morgan, UBS Securities, and DBS Bank. Having that level of top-tier institutional backing really highlights the immense gravity of this healthcare giant entering the public markets on August 1st.
Section 2. Manipal's business footprint.
10,761. That number represents their immediate physical impact. As of September 30, 2025, Manipal reported having 10,761 actual licensed beds across 38 hospitals. This isn't just some business plan sketched out on a whiteboard. This is a vast, heavily operational infrastructure deeply embedded in India's healthcare system. And the crucial takeaway from the draft red herring prospectus is this. Manipal Health Enterprises is currently the largest pan-India multi-specialty hospital network by bed capacity, period. And it actually gets even bigger. When you factor in their pro forma basis, that capacity scales up to an incredible 12,367 licensed beds across 48 hospitals. Plus, they operate 17 clinics. They are expanding aggressively.
So what exactly happens inside those facilities? They provide incredibly comprehensive, high-complexity care. We're talking organ transplants, oncology, cardiology, neurology, orthopedics, and preventative healthcare. This perfectly reinforces the company's foundational objective, which traces all the way back to its origins when the Manipal Group was started by TMA Pai. The ultimate goal? Give good quality care to patients and make critical healthcare far more available across the country.
Section 3. Deep dive into financials. Now, what's absolutely fascinating here is the sheer velocity of their top-line growth. Look at this rapid scaling. In fiscal year 2023, revenue sat at roughly 4,927 crores. By fiscal 2024, it jumped to over 6,265 crores. And then, by fiscal 2025, it rocketed to 9,409.12 crores. That is an explosive revenue jump in just a few short years.
But importantly, that revenue growth isn't hollow.
Take a look at their profit after tax, or PAT. Even while investing heavily in expansion, their profit has maintained a super steady upward trajectory alongside that revenue. It grew from 414.20 crores in FY23 to 533.20 crores in FY24 and reached 534.80 crores by FY25. So they're successfully managing to grow this massive footprint while holding tightly onto profitability.
This brilliantly illustrates the company's financial momentum leading right up to this IPO. We're seeing a nearly doubled revenue footprint over just a 24-month period. But honestly, what's truly jaw-dropping is the jump in their total assets, from roughly 7,936 crores in 2023 to an astounding 21,443 crores in 2025. And by September 2025, those assets grew again to over 22,579 crores. Plus, when you look at their valuation KPIs for FY25, they boast a remarkably strong EBITDA margin of 27.26% and a PAT margin of 13.12%. That is serious financial discipline while scaling at breakneck speed.
Section 4. Stacking up against peers. Let's break these metrics down side by side. When you look at established public peers like Apollo, Fortis, and Max Healthcare, you start to see exactly where Manipal slots in. Pay close attention to the return on net worth percentage. Manipal is sitting at a very healthy 18.16%. That competes directly and quite favorably with industry leader Apollo Hospitals, which sits at 17.61%. Sure, Apollo's absolute EPS is much higher at 105.6 compared to Manipal's 9.25, but Manipal's efficiency in generating returns on equity is incredibly competitive within this elite group. So, to summarize Manipal's specific fundamental valuation KPIs from the DHRP, you've got exactly the numbers you need to evaluate this offering: an earnings per share of 9.25, an impressive return on capital employed, or ROCE, of 26.98%, a strong return on net worth of 18.16%, and a net asset value of 50.91 per share. These are the solid anchor points that institutional investors are going to be heavily scrutinizing as they build their books.
Section 5. Focus on the fundamentals.
This quote directly from the source material is literally the most important takeaway of this entire explainer. Do not subscribe for an IPO by just seeing the premium price. Subscribe only considering the fundamentals of the companies. A gray market premium of 50 rupees is exciting for sure, but it is totally unofficial and it can change anytime before the actual listing. A true smart investment strategy relies entirely on the verified fundamental data we just walked through. So I'll leave you with this final thought as we approach the tentative July 27th open date. When you're evaluating the monumental entry of Manipal Hospitals into the public markets, what's going to guide your analysis? Will you let yourself be swept up in the daily, unpredictable swings of the gray market hype, or will you trust the hard, fundamental data sitting right there in the prospectus? Thanks so much for joining me on this deep dive, and keep learning.